So after that wonderful discussion with Dr. Joshi Jacob and Mr. Ravi, so we are moving on to the next session. The next is on the momentum investing and its crashes, the drawdown termite by Mr. Manish Dhawan. And to take the session ahead, let me call upon stage Mr. Yogesh Narayanan Sundaram, ACA CFA. Yogesh is a registered valuer and insolvency professional. He is founder and CEO of Omega Valuation Services. He is based in Chennai. He is focused on valuation of businesses and financial instruments for private placements, M&A, corporate actions, and other special situations. He was earlier director with Srinidhi Investment Advisors. So Yogesh holds the CFA charter from the CFA Institute. He is a qualified chartered accountant, insolvency professional, and a registered valuer. I welcome Yogesh on stage.
Good morning, everybody. Welcome to the second session on momentum investing and its crashes, a drawdown termite. So in the first session, we saw Dr. Joshi Jacob presenting about multi-factor models and the different ways to construct factors. One of the factors that he mentioned was momentum. There are two types of momentum, earnings momentum and price momentum. So in the second session, we are going to focus more on price momentum. This session is going to be done by Mr. Manish Dhawan. Mr. Manish is the founder partner of Mystic Wealth. He's a SEBI-registered research analyst. He has 13 years of experience in the industry, and he heads the momentum and options desk at Mystic Wealth. He's well known in India for his podcast, which is called Stoic Talks. Check it out on YouTube. And that podcast basically profiles, investing famous personalities in the investing world. And he is known for his expertise on factor investing and options trading. And he runs a very popular blog called mysticwealth.medium.com, which covers a wealth of wisdom on these topics. So welcome, Mr. Manish. Over to you.
Right. First of all, thank you, CFA, for inviting me over. This is my second talk at CFA. Also, thank you for bailing me out from the gas chambers of Delhi. It's not as bad, by the way, in Delhi as they make it sound, as long as you've got 5 air purifiers per room, that is. Right. My topic today is momentum investing and its crashes, the drawdown termite. Now, this particular presentation is in continuation to what I said in my first presentation at CFA. So, and I was worried how would I link the two presentations. That was made easy by one of our followers who did a tweet thread for our previous two presentations. And so I'm just going to run it through you so that once you're up to speed, and then we'll move to the second part. So the first topic, the first and foremost thing that you need to keep in mind whenever you're getting into the world of investing, be it momentum or value, is figure out what your game is, knowing thyself. There are two perspectives in investing. Either you react to what's happening, or you try to predict what's next. And as a practitioner, you need to figure out what's your game. The last thing you want to do is practicing a totally different craft from your personality. Like a leftist example would be a man trapped in women's body. So I have live examples here, a couple of them from current bull market and the previous one. So I know momentum investors who decided to filter out the PSU stocks out of their ambit, which was pretty ridiculous. They used their own discretion and simply removed the PSU stocks. And without the PSU, the momentum had no zing to it. So they used their fundamental filters to tweak the momentum thing, which is a strict no-no. Even before you get into the market, you have to decide whether you have a fundamental bent or a factor way of looking at things. And these are totally two different ways of looking at life. Mixing doesn't work, and you will in fact end up screwing the alpha. So the easy way to do that is that if you have a surrendering personality, where you just give in to what's happening and you are reacting post facto, then momentum investing is suited to your personality. Whereas if you like playing chess or you want to outsmart the market, guess where it's going to go next, then value investing is your thing. So even before you enter, decide which one is your thing. What is momentum investing? This is something we covered extensively in my last session, so I'll just briefly go through. Simply put, bhav bhagwan che, whatever's going up will continue to go up. Our idea is to stay long the companies that are exhibiting price action, and we will exit them once that momentum has waned out. Now, I also covered in that presentation why momentum investing does not get its due share compared to, let's say, value investing. The reason is human beings think in terms of stories. Stories sell. You cannot really create a narrative around my buying because the rate of change of a particular company is good. Narrative, on the other hand, help you build up proper cult and story around it. History of momentum investing is as old as the hills. The initial studies were done in 1920s in US, and then Jagdish and Titman paper got really famous. Post Titman's paper, a lot of research papers have been written extending on this research, where they use the same parameters on various geographies world over, and the consistency of momentum is such that it cuts across all the geographies. It works everywhere. Eugene Fama, the father of efficient market hypothesis, himself confessed that it's the premier anomaly. Now, the relationship between momentum and mean reversion isn't contradictory at all. The cycles are different, guys. So a lot of people give this rebuttal saying that mean reversion will destroy any momentum any stock would have. What they miss is that the cycles are totally different. In momentum investing, what we are essentially capturing is the immediate effect that kicks in lot before the mean reversion kicks in. Mean reversion is usually a 3 to 4 year cycle, whereas momentum look-back periods are 3, 6, 12 months of performance continuing for another 3, 6, 12 months. Now, there are types of momentum. There is absolute and relative. I'll not waste time on this. We've covered this extensively. But just a brief, absolute is where you are judging a particular asset class, comparing it with itself, not anyone else. So let's say a 200-day moving average is absolute momentum because you are judging that stock with its own moving average. Babin Faber, this is a guy we did podcast with as well, showcased this pretty interesting thing where he would just go long stocks which are above their 10-month moving average and exit when it falls before 10-month moving. Sounds very simple, but it works, beats daylights out of the buy and hold. We did this back test on DSP BlackRock Microcap Fund as well. I will not go into the details. You can go through that on my blog at medium.com, Mystic Wealth. It works beautifully. Now, relative momentum is where we excel at, where we are basically creating a portfolio of stocks based on its relative strength, which is to say, this is an example that this gentleman has given. We don't necessarily follow this because 3-month momentum is too short a time. But the idea is same, which is you rank the stocks based on rate of change with a look-back period of, let's say, 12 months or a combination of average of 3, 6, 12 months, and you're going long those stocks. Just doing this, repeating and rinse and repeat this generates pretty decent alpha. Andros Klenow wrote an excellent book on this subject, Stocks on the Move. We backtested this in the Indian markets as well. This works as well. Has crazy drawdowns, but it still works. Now, pitfall of momentum investing, this is what we discussed in our last session, was that on average, you're expected to lose. So it's worse than a coin toss. So at any given point of time, if you're taking a trade, the underlying assumption is that it will make a loss. It's worse than a coin toss, paisa jayega hi. In the overall scheme of things, we make money because of the risk-reward skew. When we win big. and when we lose, we are losing quite small amounts. And so in the overall scheme of things, the CAGR kicks in and you do really well. However, psychologically, it's a very difficult strategy to implement because as soon as you're going long, your underlying assumption is there is a 70% chance, 60 to 70% chance that that particular one trade will lose money. Similarly, another drawback of momentum investing is that it gets really top heavy. Not always, you can always trim it down, but we usually at Mystic Wealth Momentum do not do that. So there can be occasions like in 2017 bull run, we became Adani heavy like crazy. So 5 Adani names came in our 20 stock portfolio. So there was Adani Gas, Transmission, and so enterprises. So it can get really heavy and not easy for you to sleep at night because if you're basically taking a concentration risk of one particular group itself. Another drawback of momentum investing that we discussed was choppy markets are its nemesis. Like 2018 and 19 was a bad year for us. And I tell you why choppy markets are bad. See, the crashing markets are fine because we are able to take a cash call and sit out. Like for example, in Corona crash, Mystic Wealth Momentum had a drawdown of 9%. That's it. Second week of November, we were out because the second week of February, we were out. And we were just sitting in 100% cash while the market tanked. It's that zigzag up and down market that 2018 to 19 was, that is a killer because that will not allow you to take a cash call. And even if you do take a cash call, the coming back signal would come again. And so 18-19, we had a drawdown of around 28%, which was the worst that we have ever faced. And yet, despite all that, we have done really well. So momentum investing in India has really carved a niche for itself. From 2017 till date, we have averaged 29.8% CAGR. So despite all the negatives that I mentioned, the alpha is there to be seen. Among all the factors, momentum shines through. Now, ये तो हुआ पुरानी बात. This was all that was discussed in my previous session. Now, what next? Now, amazingly, all this while there was a noted alpha in momentum, and amateurs like us were able to figure out, surprisingly, mutual funds were sleeping at the door. There was not even a single offering from any mutual fund covering this amazing factor. But as RJ had said, that if the bar is open, people would come. And similarly, now they have sniffed the nectar. Now mutual funds are waking up to it, and they have realized that there is definite alpha. And not only have they sniffed the nectar, have a look at the current list right now. Absolutely, who is into momentum now? Now the question is on the opposite side. Is there anyone who's not in momentum? So these guys started the journey first. I think UTI, Nifty 200, Momentum 30 were the first guys who came in. I think the institutional imperative plays here as well. Generally speaking, mutual fund industry would never venture into something new for the fear of falling, because you don't want to be the only one falling, and as long as everybody is falling in a group, it's fine. But then the opposite happens. The herd behavior kicks in, the social proof kicks in. It's only good for the momentum as a factor. The current AUM stands at 23,544, and it's only increasing. Everybody's joined in the bandwagon. Now, my presentation today is actually a warning sign. And this is, and for the practitioners like us, the PMS and the AIFs or the RAs or the RIAs, people who are trying to carve their own niche in the industry. This is an analogy I've taken from my kids' Minecraft. I don't know how many of you follow Minecraft. This is the netherite sword, and that is a wooden sword. There is absolutely no comparison between the two. Netherite sword's made of diamond, so it's hard, and it's like the best sword in the game of Minecraft. Whereas wooden craft is crap. It's good for nothing. It doesn't do anything. Right now, as I see it, this is precisely what the war between mutual fund momentum versus DIY, PMS, AIF momentum is. And the reason is a tax benefit. It's a game changer, if you ask me, because both are going to do the same set of things, going long on stocks based on rate of change, or sharp, or any nuance that you might add. And the tax advantage that mutual funds enjoy will decimate daylights out of the same strategy being run under a PMS or a AIF. Now, I hear this rebuttal from the industry experts when I raise this concern, and they say we have something what is called as a alpha in terms of rebalance frequency. So what the practitioners are saying is that because AIF guys and the PMS guys can rebalance their portfolio on a monthly basis or a weekly basis, we have still got some bit of edge over and above the mutual funds, which according to me is not much of an edge at all. In a bull run, quarterly rebalance does not change anything. Monthly rebalance doesn't really add any much value. Secondly, nothing stops mutual funds from waking up to this as well and changing their rebalance frequency to monthly. Then what do you bring to the table? In that case, they will have an advantage of around 4 to 5% every year. And to bridge that 4 to 5% gap is huge. Now, there is a problem though. I mean, it's depends which side you're looking at from. There's a problem if you're a mutual fund, and a silver lining, line of hope if you are an AIF or a PMS. And the silver lining is this. Momentum is a two-edged sword. As the name suggests, momentum, it goes crazy. It goes crazy on the both sides. Now, this is Nifty 500 weekly, and this basically cracked 70% in a dot-com bubble. We do not have data for what happened to momentum investing in a dot-com bubble because we don't have data. Even NSE doesn't provide data as far back as that. But it's safe to assume that it will be a lot more than 70%. In fact, if I'm a betting man, I would say they would have lost 80 to 90% in a dot-com bubble. Just imagine, 80 to 90% index losses. It's unsustainable. Then this is 2007-8 subprime crisis. Similar story. This is an index fall of 68% in 2008 subprime mortgage, and this is Nifty 500 weekly. The momentum index fell even more. Another thing to note about backtest, guys, is that Ed Sakota, in his seminal paper and on his website, FAQ, mentioned this very intriguing fact that whenever you backtest and you're figuring out the drawdowns of your particular strategy, remember, the actual drawdown will always be bigger than the backtested drawdown. There are lots of host factors that would change, there are a lot of variables that would change. There will be human execution errors. So this 68% will so easily become 78, if not more. And so this is where, as far as I'm concerned, the edge for PMS and AIFs lie. All these mutual funds, the momentum funds, will fall 70, 80% in a bear market. Now, Corona could have so easily had a similar fate. A V-shaped recovery basically saved them. There was no guarantee that a V-shaped recovery could have come. This could have so easily had turned out to be another 2008, 2009 kind of a setup. Now, to that, I keep hearing this rebuttal that Fed has woken up to these problems and ye galti ab dobara nahi hogi, we'll never see a bear market again the way we saw in 2008 and 9. My rebuttal to that is that history doesn't repeat itself, but it often rhymes. And not necessarily a subprime crisis would happen, but something else would happen where you'll do the stupid mistakes and you'll have the same crash all over again. Excuses would be made, would be given to you, but the point is the bust and boom cycle plays out every time. There will be bear market, and these momentum funds will again shed away 70, 80, 90% of their NAV. Now, we have a pretty intelligent crowd here, so I was really skeptical about putting this slide because it's very self-evident and obvious, and yet I decided to put it here because it hits the chord every time you look at it. It's deep maths, guys, just understand. Till the time of 25% drawdown, you're just fine because your recovery time is okay. You just need 33% to claw back to where you were. Beyond 25% drawdown, it starts getting really dicey. It really starts getting stupid. The math starts going against you. And remember, all these mutual funds, the momentum funds, have fallen in this bracket, 75% plus, let's say 80%. They would require 300% return just to break even, come back to from where they've fallen. And remember, this table doesn't tell you an important statistic, which is time, exactly. 300% return, I'm okay, willing to go that deep and maybe 300% return, I'll be fine to claw back. But do you realize what kind of time it would take for you to claw back 300%? What is our average investment life cycle? You start at 25, 30, average age in India is 65, 70. You got 30 years. Almost 10 years would go just clawing back this 300%. 1/3 of your investment journey can be screwed just because of this drawdown. Simple heuristic to spot asset gatherers. I'm of the opinion anybody who's not talking about drawdowns is an asset gatherer and is not fulfilling his fiduciary responsibility. Now, I'm not saying that we will be successful in reducing the drawdown. Maybe we will fail as well, but at least we have an intention to reduce the drawdowns. To not have an intention at all and be willing to fall and blame it on behavior gap is just ridiculous. It is our fiduciary responsibility to safeguard our clients from these kind of crazy drawdowns because there is no coming back out of that. You hit your uncle point, you throw in the towel. It's game over. Now, buy when there is blood on the street works only when it's not your own blood. I mean, inherently we're talking about timing here. If you're not timing it, how will you deploy your money? Isn't it hypocritical? Over my 25 years in the game of quantitative investing, I've honed in on the only math that really matters. Minimize drawdowns during unfavorable times. The multiplicative nature of positive returns during good times does all the rest. This is golden. When this hit me, I was speaking with my partner Daya on this particular topic, and we went back and checked all the multi-baggers that we have achieved over the years. For the uninitiated, my partner Daya handles value investing while I take care of the momentum. Back when we started, we were only doing value investing, special situation investing. And we looked back at all the winners that we had. We were basically looking for inefficiencies in demergers, spin-offs. So all the ones that we had, the Intellect, Majescos, Kaya, Orient Paper, Orient Cement, they became 5-bagger, some became 3-bagger, 4-bagger. The underlying conclusion that we drew through our conclusion was, do we really think it's our research that made us the money? I mean, sure, I'm not taking the credit away from the research that we did and we were able to spot inefficiency. But in essence, what that research did was nothing but gave us the endowment bias and the conviction to hold on. Otherwise, we would have taken a 30, 40% profit on any trade and would have moved out. Just because we had done some work on it, it gave us this false sense of illusion and the endowment bias, which helped us hold on to those winners, and those became multi-bagger. Once again, I'm not taking away the credit for the research, but I'm saying a lot of other stocks did well as well. I mean, Suzlons of the world became five baggers. So do you really think that our research did anything? Research just does the endowment effect, which helps you to hold on to your winners. And the multiplicative nature of positive returns in good times takes care of the rest. As a practitioner, the only thing we need to worry about is the bad times. Your drawdowns should be minimized so that you get to see the good days. An investor who earns 18% every year is much better than one who earns 30% every year but gets a 30% drawdown in the year 6, or any year for that matter. If you fall, this is a maths that misses a lot of people. If your falling is steep, all your excessive alpha goes down the drain. Now, this is a small study that we did yesterday only, how timing makes all the difference. You basically, if you were entering in January to 9, your returns 20% CAGR, whereas if you were a year early, you're just getting 13% CAGR. And similarly, if worse to worse, if you're entering on a peak and chicken out at the Corona low, even momentum being a great factor that it is, your return would be 6% CAGR only. So timing, don't believe the narrative that time in the market's important, timing is not important. Timing is very important as well. Now, my question is, what do you bring to the table as a fund manager? We know mutual funds were sleeping at the door. They were not aware of the momentum as a factor. We took full advantage of that. We were pioneer in the game. We did 30% CAGR from 17 till now. But now what? Now that they've woken up to the game, how do you differentiate? What do you bring to the table now? So I'm of the opinion avoiding drawdown is the only edge available now. And that is a game changer. Now, here's a question for you. How much do you think PPFAS has achieved in CAGR terms, Parag Parikh fund, from let's say 2017 till now? Any idea? I'm using 2017 because that's when we started offering to the retail, so I started from that year only. But any idea how much is the CAGR? Sorry? Okay, so it's 21 point something, 21% CAGR. Now, I'm not picking on PPFAS per se. Let me get disclaimer out of the way. I have huge respect for PPFAS. In fact, if I have to stick my neck out and say if any one AMC that I'm interested in investing in, it would probably be them because they're, I mean, we have a pretty intelligent crowd here. You know how the market works. I mean, launch 100 strategies. At any given point of time, 2 would work. Momentum नहीं चल रहा होगा तो quality चलेगा, quality नहीं चल रहा होगा तो value चलेगा. Whichever is working, start beating the trumpet around it and say how great you are and generate AUM. Whereas PPFAS, true to their style, has stuck to one value, value investing as their style, just unbelievable answerability and accountability. If that strategy goes down, they go down with it. So credit where it's due. But that's not the point. What have they achieved? The PPFAS has achieved 21 point something 5% CAGR over these 7 years. And what is their benchmark? We don't know their benchmark. I mean, if I were to guess, I think 65% India stocks and the rest in NASDAQ 100 would be their ideal benchmark. And if you run it parallelly, they have not beaten that. What am I trying to tell you here? Avoiding drawdown is the only edge available. They will beat daylights out of this benchmark after a full cycle. Because by avoiding the drawdown, by taking those cash calls, that is the game changer. In fact, that's the only edge in town. On the way up, it's very difficult to beat the index. My friend Nuresh Mirani does this very interesting random portfolio, the RAND function in Excel. He generates these 20 stock portfolios. In bull run, his RAND portfolio, 20 of them, almost 18 of them beat daylights out of all the mutual funds, all the small cases, everyone in town. So a dart throwing monkey would do better than any fund manager in town in a bull run. You beat the index or the market on the downside, not on the upside. Now, this is a slide deck I took from Alok Jain from his presentation. This is applicable in Mystic Wealth Momentum's case as well. Two strategies, everything same, the returns are same. The only difference happened in Corona, where this one just fell less and the others fell more. Mystic Wealth Momentum had a drawdown of only 9%, so हम इतना भी नहीं गिरे, यहीं से मुड़ गए. And see what the difference the end result makes. By virtue of falling less, you create all the alpha. Now, but taking a cash call in a bull run is a functional equivalent of, if this is writing on the wall, and if this is so, if I'm able to figure out, I'm sure everybody's able to figure out, फिर भी लोग cash call लेते क्यों नहीं हैं? इसलिए नहीं लेते. You look like an ass if you do that. I mean, this is happening as we speak. Friday had a rip-roaring rally, right? We are sitting on 40% cash. We look like idiots. 1 in 3 cash calls would show a profit. In a bull run, this would happen. The wildebeest stampede is like buy the dip crowd. They will decimate you. It happened on Friday. We don't know how the market will behave on Monday, but while you are sitting on cash, your competitors are all fully deployed. They will beat you. Having said that, we will still stick to it. Because of the previous slides that I shared with you, we have a fiduciary responsibility to our clients. We don't want to get into situations where we are so way down that there is no way to claw back. Now, there are 4 ways of reducing the drawdowns. This is not my joke, this is Ed Sekoda's joke. In one of the seminars, somebody asked him how to avoid a drawdown, and he simply said, don't trade. Because as long as you trade, there will be drawdown. You cannot mitigate that, but you can reduce the drawdowns. How do you do that? First way of doing that is to do what is called as uncorrelated strategies. Strategies that go up at different times. We'll talk about that. Another way to do that is to do what is called as uncorrelated asset class. So if you long the stocks, then the uncorrelated asset class are the USD INR or the gold. You dilute yourself with that much of gold and bring it down to your pain threshold. Third way to do it is what is called as equity curve trading. This is what I do. This is not for everyone. We'll discuss that. And the fifth one is long-short portfolio. This is made available now that NSE has come up with 45 new names as well in the FNO segment. So they're opening up the gambit, so you can do a long-short as well. That creates a smoother equity curve. Now, what about buying out-of-money puts? This is also one of the ways to do it. A lot of people claim that मैं हर साल allocated amount की puts खरीद लूँगा, so I'm totally safe. First of all, there are 2 drawbacks in this system. First of all, the puts that you will buy will be on Nifty. And beta of Nifty is not same as beta of your small cap portfolio. So it's very difficult to do an equal match. Second problem is this. This is the chart of Black Swan hedge fund soar again after years of losses. This is what happens when you buy puts. You will make profit only in 2 years. One was 2000. Okay, so this data is, this is where you made profit. And then that Corona thing is when you made profit. And psychologically, it is impossible to implement this strategy. Every year for 10, 15 years, you'll constantly make losses. Consider this as an insurance that you pay. This works, but psychologically very difficult because there'll be like 2 years in 20 years that you will make money. So this is a slide that I copied from spreadshirt.com. You need to dial it down to your pain threshold. That is the way to reduce your drawdown. How do you do that? So this is a slide where I am showcasing 2 of my strategies, Mystic Wealth Value that my partner there runs, and Mystic Wealth Momentum that I run. Remember, when I say value, I'm not talking about Eugene Pharma value as a factor. There is doing what is called as value investing. So he's doing spin-off investing, management change as a theme investing, growth at reasonable price investing, not value factor. Notice this beautifully how when we mix 2, the overall drawdown comes down to 21% without sacrificing too much on the CAGR. And the reason why this is happening is because both these strategies are taking cache calls at a different time. When I am fully deployed, Daya is in cache, and vice versa. And so this works as a combo, works beautifully, reducing the drawdown and yet not sacrificing on the alpha too much. Other way to do that is to dilute it with an uncorrelated asset class, which is gold in this case. You simply, like 70-30 between momentum and gold, gets you more or less the same CAGR. It's a cut for sure, but the drawdown gets reduced considerably. Now you're 20%. So this is one way of dialing it down to your pain threshold. Then there is a concept called uncorrelated strategy. There's this guy, Lawrence Benstrop. I highly recommend you read his book. We were supposed to do a podcast with him. I didn't do it because of my laziness, but we'll probably get to it. In this book, he's beautifully mentioned the strategies that he deploys, mean reversion strategy, and he called it the puddles. So the concept of puddle is that, let's just say you have a normal long-only strategy. The equity curve of long-only strategy would have these dips, these drawdowns. And let's say if you fill these dips with water, it will basically look like as if they are puddles in on a road. He basically says that you need to fill these puddles with uncorrelated strategies. It's beautiful how he explains that in his book as well. While the long-only strategy is generating alpha in the long run, the puddles are getting filled by the mean reverting strategy, where he's shorting the stocks on basis of being overbought. And as a combo, they work beautifully. Standalone, mean reverting strategy probably is not even profit making in 2 out of 4 years. But that's okay. But because of the combo, the puddles get removed and the equity curve becomes very smooth. Other option is, of course, the option writing short volatility. That's a separate topic altogether. You need to be good at the craft and avoid black swan events. Then comes the concept of equity curve trading. Now, this is something that I practice. What you do is you create a NAV of your own equity curve, which is nothing but collating data as to what's happening on your portfolio. That line becomes your asset class itself. Now you will run a trend following system over and above that equity curve itself. So in this example, I've basically done a simple 21-day moving average itself. And you can experiment with a lot of trend following systems like Donchians, like ATRs, etc. Having said that, this is not for everyone, because this entails you taking 100% cash call every time a sell signal comes. This is not easy, but it does reduce the drawdown considerably. So this is an example of the system that I plotted on my AMI broker, the cash call that it comes. It basically has given 6 cash calls in 7 years, and out of which I think 2 have actually worked and saved the drawdown, 4 were bogus. And yet it's still worth doing, because it reduces your drawdown even by half. So MWM had a drawdown of 28%, whereas in my personal book I had a drawdown of 12%. But it's not for everyone, because you have to take crazy cash calls. How many of you know about this Rory Sutherland's clock? Anyone? No. So at least you'll learn something from this presentation today. So this is a pretty interesting clock that Rory shared in his presentation. The outside dial is the obvious miles per hour, which is just calculating the speed at which your vehicle is moving. The inside dial is calculating the number of minutes you're saving by increasing your speed. So there is an optimum level of speed at which you're supposed to drive. If you are driving too slow and you increase your speed, you'll notice you are safeguarding your time considerably. Let's say from 10 kilometers, if you move to 30, you have 1/3 your time. It would have taken you 60 minutes to reach your destination. Now it will just take you 20 minutes. So increasing your speed when you're too slow works beautifully and you save time. However, this clock fails on its head when you're already at optimum speed. Let's say you're at 70 kilometers per hour and you go crazy and you drive at 100. Now, you have just saved 3 minutes and you've taken a substantial life risk of actually getting killed. So the correlation with this and drawdown mitigation is that while it's very important for us to remove drawdowns or reduce drawdowns by doing these strategies, there's an optimum level till which you are supposed to do it. If you overdo it, the corresponding benefit is hardly anything and you are taking substantial decision risk. Because remember, every decision has a decision fatigue to it. And if you're taking too many cash calls or too many liquidations, let's say in this example, 70-30, the CAGR is 25% and the MDD is 20%. But if you're like too conservative and you're going 50-50, of course your drawdown would come down. But now you're taking crazy decisions because 50% of your net worth in gold is dicey, is risky. And also your CAGR would come down. So remember the Rory Sutherland's clock whenever you are trying to reduce the drawdowns. There is an optimal mix that you could, doing nothing is bad because you'll have crazy 70% drawdowns. Doing too much is also bad because you'll have a decision fatigue. So in short, the conclusion is lesser drawdown is the only edge as I see it. Otherwise, mutual funds are well equipped to do precisely what we have been doing. They can hire the same resources. 4 ways of achieving it. We discussed the 4 ways. And then the last point is don't overdo it. With that, it's a wrap. Thank you.
See, my first question to you is, you said the momentum composite factor that you construct. It's a combination of 3-month, 6-month, and 12-month momentum. So the academic literature says the 1-month momentum is a reversal factor. So when you say 3, 6, and 12, for the benefit of the audience, can you say, are you talking about the momentum from T-1 to T-4 and T-1 to T-7?
Yeah.
Are you lagging the momentum by 1 month?
Yeah, so we are not doing 12-1, if that's your question. So we at Mystic Wealth are not doing the -1. So for the audience, the -1 basically means you discard the latest month's data while calculating. That's how the academic research has panned out. We don't do that. We're calculating flat 12 months.
Okay. And you said you look at the momentum factor and you rank stocks and you pick the top decile stocks. Okay. So my question to you is, what if there is change in momentum? So a stock has moved from the 5th decile to the 2nd decile. And it's going to come late into your portfolio because it hasn't moved yet into the 1st decile. So do you ignore those stocks, or you allocate less weight to those stocks? So do you look at change in momentum rather than just absolute momentum?
No, we don't look at change in momentum. The decile changes do not change anything. We are looking at momentum itself, the average of 3, 6, and 12. There are other nuances that go into it, the distance from all-time high or the 52-week high and stuff like that. Also, what we have coded is trying to capture various stages of the momentum. So there can be late-stage momentum, there can be early-stage momentum. So that's also part of the code. But to answer your question, the decile, the change in rate of change, we are not doing that.
Okay. And you said about the portfolio turnover, it's not easy to implement for a retail investor. So can you talk more about it? What are the tax implications? And how often do you suggest is the optimal rebalancing frequency? You mentioned about monthly rebalancing, but how does quarterly and work in relation to monthly?
So, interesting question. I think it's more to do with psychology, Yogesh, rather than just plain factors, plain return factors. Like, for example, I personally, even if the monthly returns are same as quarterly returns, I would never be comfortable doing a quarterly rebalance. The strategy has to suit your personality. Like, I cannot just sit looking at a crash and not do anything for our entire quarter. So for me, a monthly rebalance is the least that I would be working on, regardless of what returns difference there would be. Having said that, we've done the back test. In a bull market, quarterly rebalances works just fine. But in the shifting environments, the monthly rebalances have an edge.
Okay. So you discussed about cash call, and you said it's a difficult strategy to implement because you're crucified when it goes wrong. But Warren Buffett, in 2000, he was sitting on 15% cash. 2008, 25%, and now he's on 30% cash. So when one of the most successful investors has taken a bold cash call, why is there so much backlash in the investment community when the mutual fund manager does it?
First of all, there is only one Warren Buffett. And secondly, Warren Buffett's not reporting to anyone. Even despite not reporting to anyone, he received crazy amount of flack in the .com era. I mean, there were articles after articles that were published, people saying old man has lost his charm and whatnot. So he did go through the flack, even when he was not managing people's money. So these are the 2 points that answer your question. Because he's not managing people's money, he can take crazy cash calls. Even right now as we speak, he's sitting on pretty decent amount of cash.
Okay. And you spoke about the 4 strategies, the uncorrelated asset, the long short, the uncorrelated, the asset classes, and, options, tail risk hedging. Okay. So on tail risk hedging, it's a favorite topic for me. Nassim Taleb's Black Swan Fund, managed by Mark Spitznagel, he published a paper where he said, if you allocate 97% to an S&P 500 ETF and 3% to a tail risk hedging fund, you've beaten the daylights out of S&P 500 over a long time frame.
True.
So it's just a question of allocating 3% of your portfolio. And why would somebody be worried about it when it's going to perform only once every 10 years? So when it's only a small fraction of your portfolio.
I 100% agree with you. I covered that in one of the slides. It's the same problem as why don't people do life insurance? They're supposed to do life insurance. Similarly, they're supposed to do portfolio insurance.
Okay, so we'll take questions from the audience. So the first question is, in a drawdown, if you're betting on momentum factor, should you do lump sum or SIP?
In a drawdown, if you're timing a drawdown, lump sum would be better, of course, mathematically. But can you time it successfully is a different question altogether. So at any given point of time, anytime a client comes to me and asks this question, is this a good time to buy? My answer is simple. Be ready for all the 3 scenarios. That the next year will be a crazy bull run. We hit triple-digit returns. Next year is a 2018-19 kind of a chop fest where we give away 28%. Or a bear market where we will successfully be able to take a cash call. So be ready for all the 3 scenarios.
Okay.
And we cannot predict what will happen next year, and I'm willing to extend that to everyone. Nobody can predict except liars.
Okay. So one more question. As a wealth management company, how do you allocate between momentum investing and value investing, given that you will have clients requiring a combination of both? This is a question asked by Prabhat. So is it based on client requirements, outlooks, behavior? So how much discretion does the client have when it comes to advising you on momentum and value investing?
Great. So we are not running any AIF right now as we speak. We're in a process of getting one. But right now this problem does not occur because we have 2 separate products. So clients are free to choose any one.
Okay. So there's a question from Harsh. How does sector biases affect momentum investing? How do you mitigate those biases?
We at Mystic Wealth are sector agnostic. We are market cap agnostic as well. We don't look at sector-wise momentum. We are just looking at the overall picture. And even if we get one sector heavy, it's fine.
Okay. And your thoughts on value and momentum as negatively correlated? So would it make sense to combine both? This is a question asked by Darshan.
So this is a pretty interesting question, and we have found that this works beautifully. But having said that, I need to add a disclaimer. we have added Mystic Wealth Momentum and Mystic Wealth Value, which is not the quantitative value factor. So this is basically individual discretionary value investing of my partner and systematic momentum investing of our product. That combo has worked beautifully. But I don't know if the value as a factor with momentum works or not. And the reason why I say that is because both of them are market linked. And so I have a feeling both of them will fall at the same time.
Okay. So one question, which the audience would like to ask, are there specific tools or resources that you would recommend to understand more about momentum investing? So you've spoken about few academic papers, but do we have something like the Pharma and French library, which gives you the month-wise, the quarter-wise, year-wise returns of different types of momentum indicators?
So Professor Raju has written a research paper detailing all that in the Indian context, and it's a very nice paper. You should go through that. Also, I have elaborated all the resources. Google Mystic Wealth Momentum Money Control article. That article has around 10 resources that I've recommended. Anybody who's interested in momentum investing should go through. AQR has written some papers, and a couple of books I've recommended as well.
Okay. Okay, thank you, Manish. I think we have run out of time. Thank you for the wonderful session on momentum investing. Do read his blog and the podcast on YouTube. Follow him on YouTube.
Thank you.
Thank you.
Thank you, Manish. Thank you, Yogesh. I request Mr. Ravi Sarogi to please gift Mr. Manish. Okay, I'll gift Mr. Yogesh.